Hi Warren, thank you for joining us for ANZ Blue Notes today.
Thank you.
There's concern currently about a housing bubble in Australia. Do you think those concerns are justified?
There's certainly a risk that we're moving into that territory, but where we sit right now in late 2014 is not a housing bubble. There are some excesses forming around the Sydney market. That is a very historically high level of investor activity. But this is not a broad-based bubble. Outside of Sydney and Melbourne, house price gains are lethargic. We're talking 3, 4, 5% for the other capital cities, and the amount of leverage in the market outside of Sydney and Melbourne is quite modest. So a housing bubble really has to be characterised by a broad-based increase in leverage and rising prices and unsustainable speculative behaviour, these sorts of things. The issue is that we have the platform to form a bubble in the next few years. We've seen a significant increase in prices in Sydney, in Melbourne over a number of years, and there is some momentum outside of those major cities, and that means that expectations for capital appreciation are starting to form. What we want to watch and where we think it can become a real problem is when we get a broader element of the community getting involved in investment property that is on a short-term speculative view, and that's where you get into problems.
Do you think the Australian dollar has settled at its current level?
Look, the Australian dollar has moved significantly against the US dollar, but not against a broad suite of currencies. So really the big move down in the Aussie-US exchange rate is a US dollar strength story more than anything. The Aussie is actually near a new sort of multi-year high against the yen, and is holding pretty well against the euro. So I think against the US dollar, we would likely see some further downward movement, but it'd be minor. Our forecasts are for the Aussie-US exchange rate to get to sort of 83 to 85 in the middle of next year, and that's sort of a cyclical low point. But we could see the Aussie weaken against the euro if stability in the European economy comes through over the next 6 months. And the yen's a tricky one. There's a significant monetary stimulus going on there with the Bank of Japan, but that exchange rate's has moved quite a long way, so that might sort of sit around this level for a while. So the Aussie will unlikely move much against the US dollar, but it could against some of these other currencies.
ANZ's view on interest rates is slightly different to that of the rest of the market. Why is that?
We take a view that Australian interest rates at the moment are lower than what they will average over the long term, the next 5 years. That is, there's this concept that central banks use of a neutral interest rate, an interest rate level that neither is supporting or hurting the economy more broadly. And our view is that's above where we're at now, and the easiest evidence of that to point to is the fact that the housing market in Australia is doing so well, because that's one of the sort of the key ways that interest rates affects the economy. The Reserve Bank is in no rush to move on interest rates because they're at this sort of early stage of the non-mining recovery, and they want to sort of see that get some traction, see the unemployment rate stabilise, and even maybe look like it's coming down before they move. But I think they would like to see interest rates a little bit higher, because these low interest rates, by Australian standards anyway, are creating some risks in the housing market. Not right now, but potentially down the track. So we think that in the middle of 2015, maybe in the second half, the Reserve Bank may take the opportunity to raise interest rates 50 or 100 basis points if the world economy is looking better, if we're seeing some traction in the non-mining economy, and if we're seeing the labour market stable.
There's global concern about a hard landing in China. Do you think from Australia's perspective that the growth of ASEAN nations is somewhat offsetting that risk?
It will over the medium to long term, and certainly we see this sort of natural transition of growth in Asia moving from the north to the south, but it is a medium to long term proposition. China's ability to industrialise, to build out an infrastructure and to achieve rapid growth, I think is unique. India, Indonesia are the two major economies. The Mekong as a region is very important, but the economic and political structures in those countries suggest that the industrialisation process, the next level of development, will be more gradual than what we've seen in China. So if China gets itself into some sort of financial difficulty or has to slow its economy quickly in the next 2 or 3 years, I'm not sure that ASEAN can effectively offset that. But we do see this more gradual slowing in Chinese growth over the next 5 to 7 years, and then ASEAN picking up the slack over that sort of a time period.
Thank you again for joining us.
My pleasure.